Hello students, you are the future chartered accountants of India. We have discussed till the capital gain chapter. From today onwards, we are aiming to complete the income from other sources. This is the last heads of income from the 5 heads of income out of 5 heads of income. That is income from other sources. Without wasting for them, welcome you all for today's Abhi CA classes. I am CA Abhijith Acharya. Section 56 subsection 1 says that any income which is not taxable under the head salary, income from house property, capital gain, PGBP, income heads shall be taxable under income from other sources. It is short in it is called as IFOS. Okay, section 56 to 56 subsection 2 says following income are to be treated under income from other sources. Number one, dividend, income from lotteries. Two, the income from lotteries, puzzles, and card games. Next, any sum from employees towards contribution for PF and ESI, etc. If it is not chargeable under PGBP, if it is being charged under PGBP head, then that will go under PGBP head, not under income from other sources. Interest on securities, rent from the let out house let out of plant and machinery and furniture with or without building if not chargeable under business income. Amount received under key man insurance policy not taxed under with the PGBP. If it is being taxed with PGBP, then those are chargeable under the same head, not under income from other sources. If it is not chargeable, then it should be charged under income from other sources. Okay, interest received on compensation of compulsory acquisition of capital asset. This thing we have already discussed in the capital gain chapter, that interest on enhanced compensation received shall be chargeable under the income from other sources, and respectively the 50% of that will be treated as deduction under section 57, which we are going to take at the last part of this chapter. Okay, next, a gift received is also to be chargeable under income from other sources. Family pension amount and interest on bank deposit, loan given, and interest on income tax refund. Remember, income tax refund is not taxable, but interest on income tax refund is taxable. Income from subletting of house property, then royalty income, agricultural income. Next, director sitting fees and salaries of MP, MLA, MLC. Salary of other persons, other people will be chargeable under salary head, but salary of MP, MLC, and MLA will be chargeable under income from other sources. Okay, next, taxation of gift. This is very important under income from other sources chapter. The taxation of gift says that any gift received by employee from employer due to employee and employer relationship, then it is always taxable under salary head. Any benefit or gift or perquisites arising due to the business or profession, then it is always chargeable under PGBP. Other types of gifts are to be chargeable under income from other sources, which we are going to discuss now. Any gift or asset acquired for low consideration by any person, then section 56 subsection 2 subclause 10 is applicable. If the gift is received at a nominal value, then no taxation is arising. If it is receiving or at the lowest value, in the lower value than its market value or SDV, as the case may be, then it should be chargeable as taxable income under income from other sources under section 56 to subsection 10 or subclause 10. It is classified into two. If the gift is received, first we'll see one by one. First, if the gift is received on occasion of your marriage from relative or gift is received by way of inheritance or in contemplation of death, or gift is received from or by any trust under section 12 AA, from hospital or medical institution, gift is received from any university, educational institution, or gift is received from any local authority, then 56 to 10 is not applicable, so it is not taxable at all. Okay, then otherwise category. In otherwise, other than these transaction, if the gift is received on any other transaction apart from those categories, then they are to be classified. We have to see three categories. If the gift is received in by way of money or cash without consideration, then if the aggregate money is more than 50,000, then entire money is taxable. If you receive money worth of 50 lakh 5 rupees, then entire 50 lakh 5 rupees is taxable, not excess amount of 5 rupees is taxable. Entire 50 rupees 5 rupees is taxable. Okay, up to 50,000, okay, more than 50,000 only it is taxable. Then if you receive any movable property as a gift, if you receive any movable property as a gift, then we are going to check whether that monetary item that I have mentioned star mark there, which we will discuss below under below note, without consideration, that movable property is without consideration. For example, its value worth is 1 lakh, but you have been provided that asset with the zero value, then it is called without consideration. If aggregate FMV of that movable asset, FMV means fair market value of that movable asset as on that date, is more than 50,000, then entire fair market value shall be taxed. If you receive any movable asset for inadequate consideration, for example, is say the value of that one of the movable asset, let's say for example, is 50,000, is 1 lakh rupees, but you have been provided the same with the 30,000, so there is a benefit for you is 70,000, right? So inadequate consideration means the same meaning. If aggregate fair market value, in this case, my case is 1 lakh minus consideration charged, in our case that is 30,000. If it is more than 50,000, in our case it is obviously more than 50,000 because the difference is 70,000. Then the difference, that is 70,000, between fair market value minus consideration charge shall be taxed under this head. Okay, understand? Simple. Then if you have been provided with immovable property, let's say land or building, for without consideration, then per property is SDV, that is stamp duty value. If it is more than 50,000, then entire SDV shall be taxed. If the land or building is being provided for you and as a by way of gift for inadequate consideration, then if per property is both conditions should be satisfied. If per transaction SDV minus consideration is more than 50,000, and if SDV should be more than 110% of actual consideration, the difference between SDV and consideration is to be taxed. In order to give you a clear-cut picture of this provision, we have taken one example. The consideration, let's say, of land and building is, let's say, for example, 1 lakh, whereas the SDV on that date on which the gift has been provided is 1 lakh 70,000. If you take the first criteria, that is SDV minus consideration should be more than 50,000. In our case, 70,000 is a different, which is more than 50,000. The second condition is SDV is more than 110% of the consideration. In our case, consideration is 1 lakh, its 110% is 1 lakh 10,000. But in this case, SDV is 1 lakh 70,000, which is obviously more than 110% of the consideration. So both conditions are satisfying, and the difference between SDV and fair SDV and consideration, that is 1 lakh 70,000 minus 1 lakh, that is 70,000, is to be taxed under 56 subsection 2 clause 10 under income from other sources. I hope you have been cleared with everything. Now we are going to discuss some of the notes with regard to this movable property. What do you mean movable property? Shares, securities, jewelry, drawing, painting, archaeological collection, and sculpture, any other work of art, bullion, etc., virtual digital asset. In short, it is called VDAs. VDAs means bitcoins. Any property received as gift. Next point, any property received as gift or acquired for low consideration other than above shall not be taxed. what have been mentioned above, apart from these, you have been provided with a gift which are not being covered here under, then those are not taxable, even though its considerations below its fair market value or SDV as the case may be. Example, TV, car, mobile phone, watch, these categories of asset you have been provided, then there is no the taxation would arise even though its the value is less than the fair market value. Okay, the relative means in this we have mentioned that in the first criteria, from relative, if you receive any gift, then is also not taxable. Who are come under relative? It has been mentioned particularly for this section. If you are individual or SSE, if you are individual SSE, then your spouse is relative. Your brother and his spouse are also relative. Your sister and her spouse are those relative. Your father, mother are also your relative. Then fathers or mothers, sisters and brothers and their respective spouse are also relative. Then your spouse, then your grandparents or great grandparents, which are called lineal ascendant or spouse, are also termed as relative for you. Then your brother and spouse and sisters and spouse of your spouse are also relative. Then your mother and father of the mother and father of your spouse is also your relative. Then the linear ascendant and spouse of your spouse is also termed as relative. Then anything less is lineal descendant and spouse, that is called your children, your your grandchildren, your great grandchildren are also termed as the relative. Simple. If you receive anything from these relatives, these categories of persons, then they are fully exempt. Okay. Then the second category, the relative for HUF. Any member of HUF is termed as HUF for HUF. Then note, if SSE is not satisfied with SDV, then he can refer the same to the valuation officer, same as section 50C that we have already covered in capital gain chapter. Section 56.210 is attracted only if the property is in capital in nature of the recipient. If it is stock in trade, then 56.210 is not applicable. For example, I am a trader in jewelry market. I have been provided the jewels from another jeweler shopkeeper at a price lower than the market value. Then for me it is not taxable because it is my trading business. It is my business at all. If I am not a trading person in that jewelry market, then if I have been provided with the jewelry at a lower price, then it is taxable in my hand because of that 56.210 provisions. Okay. If any person received any asset as a gift or acquires for inadequate consideration, he is already assessor under section 56.210 on FME or SDV as the case may be. Then cost of asset of such asset when I am going to sell further subsequently shall be the fair market value or SDV as the case may be when such asset is further sold out. However, period of holding of previous owner shall not be considered. Okay, simple. Then 56.210 is applicable even the gift or money is made outside India by resident to NR. Okay, simple concept. Then there is one amendment by Finance Act 2022 with effect from assessing year 2021. Section 56.210 is not applicable in the following cases: by an individual, from any person in respect of any expenditure incurred by him on his medical treatment or on any member of his family for any illness related to COVID-19 subject to the central government conditions. If you have been provided with any expenditures with related to your COVID-19 illness, then that is also not taxable. By a member, the amount following is by a member of a family of a deceased person from the employer, received by a member from the employer of the deceased person. Example, deceased person was an employee in one of the company. That company is giving some relief to the family members of the deceased employee. Then it is not taxable. Without, there is no restriction. If if the member of the deceased person receives any amount from any other person apart from employer, then the such amount to the extent of 10 lakh is not taxable. If it is more than 10 lakh received, then the excess amount is taxable. Okay, where the cause of death of such person is illness due to the COVID-19 and payment should be made within 12 months from the date of death of such person. Date of such person I have mentioned, it should be date of death of such persons. Okay, subject to other conditions by central government. Okay, then note, the death of an individual should be within 6 months from the date of being tested positive. But these are uncontrollable in nature. Everyone is praying for his recovery, but income tax, in order to provide exemption, he should be died within 6 months from the date of being tested positive. Then the family member shall keep a record of the following documents: the COVID-19 positive report, the medical report, and death certificate stating that his death was caused due to the COVID-19. That's it. Then section 43 CA, HDB shall be treated as sales consideration. In case of immovable property held as stock in trade, if sale is less than HDB, then such HDB shall be deemed to be sale consideration. This is the same concept we have discussed in the capital gain chapter also. Sale consideration, HDB should be treated as sale consideration if HDB is more than sale consideration. However, if HDB does not more than 110% of the consideration, then actual consideration, actual selling price, actual sales is considered as actual sales, and HDB should be ignored. If SSC is not satisfied with HDB, then he can refer the same to the valuation officer, same as section 50C. If date of registration and date of agreement are in conflict, that means are not on the same date, then HDB on the date of agreement can be considered, date of registration can be considered under section 56C, 50C, 43CA and 56(2)(10) if full or part consideration is received by account paycheck or DD or ECS. This the same concept we have already covered. Okay, then the section 56(2) subsection 7B, it says shares issued on premium. If any closely held company, that means private limited company, issues shares to the resident individual, the term resident is very important, on a premium, then the taxable IFOS under company in the name of company is issue price minus fair market value of the shares is taxable. Okay, then section 56 subsection 2 subclause 11, it says the compensation on termination of employment. Any compensation or other payment received by any person in connection with his termination of his employment from the person other than employer, because if it is being received from employer, then it is taxable under salary. If it is being received from other person than employer, then it is stated under income from other sources. If it is received from employer, then it is taxable under income from salaries under section 17, section 3, subclause 1. Then taxation of dividend. It is very important. Dividend income from domestic company, let's see, taxable in the hands of receiver at the time at the normal tax rate. From foreign company also the same concept, taxable in the hands of receiver at normal tax rate. The taxation of deemed dividend. What do you mean deemed dividend? Let's see. The objective of taxing under deemed dividend is to identify the loopholes in the tax provision. Accumulated profits under section 2, subsection 22, subclause A, subclause B, subclause D and subclause E include all the profits of the company up to the, actually what do you mean by the deemed dividend concept is, in order to divert the taxable income, some closely held company or some of the companies are transferring some of the assets on liquidation or any of the loans given to his shareholders or any other persons at a cheaper prices, then it is termed as deemed dividend. It is taxable under the recipient. Okay, then but it should be restricted to your accumulated profit. Accumulated profit means the asset, the taxable that is a profit lying in your the books of accounts. Okay, then accumulated profit up to the date of distribution on payment of dividend under section 222C, all the profits up to the date of liquidation shall be taxable. In case of amalgamated company, the accumulated profits, whether capitalized or not, shall be increased by accumulated profit of amalgamating company on the date of amalgamation. The both accumulated profit of amalgamated and amalgamating company should be added in order to check the accumulated profits limit. Okay. Then first we will see the section 2 subsection 22 subclause A. Any distribution of assets. It says any distribution of assets by a company to its shareholders to the extent the company possesses its accumulated profit, capitalized or not. The distribution of asset to the shareholder to the extent the company possesses accumulated profit, that should be treated as taxable dividend. Note, in case of bonus shares, there is no release of any assets and hence the issue of bonus shares is not deemed as dividend. Where assets are distributed under section 2 subsection 22A, C, D, the fair market value of the assets on the distribution should be taken for computing the dividend. Only the fair market value shall be taken because there is no value. It has been simply distributed, so hence fair market value on the date of distribution shall be taken as deemed dividend. Okay, next section 22B, it says distribution of debentures. Any distribution of debentures, stock debentures or deposit certificates by a company to its shareholders and any distribution to its preference shareholders of shares by way of bonus, both are to be taxed to the extent of the company possesses its accumulated profit. Everything is restricted to the company's accumulated profits, whether it has been capitalized or not. So this is simple. Next section 222C, distribution of assets on liquidation. Any distribution of assets by company on liquidation only to the extent of the company possesses the accumulated profit, whether it has been capitalized or not, nothing फर्क नहीं पड़ता. Next, the section 2, subsection 22, subsection clause D says reduction of share capital. Any distribution to its shareholders by a company on reduction of its capital to the extent to which the company possesses the accumulated profit, whether it has been capitalized or not, फर्क नहीं पड़ता. Then this is very important section, that is 222E. It says loans or advances by closely held company, that is by private limited company. Okay, there is one shareholder. He is having more than or equal to 10% of the voting power in closely held company. The closely held company sanctions loans or advances to that shareholders who is having 10% or more in that company. Okay, then that is taxable in the hands of shareholders because these loans and advances are treated as the deemed dividend in the hands of shareholders, so it is taxable. The first case. Second, any concern in which the shareholders is having a substantial interest. What do you mean substantial interest? We'll see in the next notes. That same shareholders is having a substantial interest in any concern, might be a company, firm or AOP, etc., to which that closely held company is sanctioning any loans or advances, then that loans and advances are also taxable in the hands of shareholders because he is having a substantial interest over that any person. Then shareholder is having any substantial interest with any person, then any person, and to which the closely held company sanctions any loans or advances to that any person, then that loans and advances given shall also be taxed in the hands of the shareholders. Okay, this is in order to avoid some of the loopholes, that's it. Okay, some people, some shareholders are diverting their income in the form of loans or advances by creating some of the sisters company, and hence in order to catch them, so this provision has been brought into effect. Okay, let's first again and let's revise once again. Shareholder having more than or equal to 10% of voting power in a closely held company which provides loans and advances to him, so this is also taxable in his hand. The same shareholder is having a substantial interest over the concern or any person to whom the same closely held company is giving loans or advances to both any concern or any persons, then that also loans and advances received by any person or the person shall also be taxed in the hands of that shareholders only, not in the hands of any concern or any person. Some of the notes: loans or advances is treated as deemed dividend to the extent of accumulated profit. Here we have not mentioned capitalized or not. Both, okay, it is not never mention of capitalized or not. But the second consideration, this rule is applicable only in the case of closely held company. But above three subclauses are applicable every company. Okay, substantial interest means more than or equal to 20% of the voting power or share in the profit at any time during the year. The shareholders is having more than a 20% of the shareholder and voting power, then he is called the having a substantial interest. Then loan is repaid or company charges market rate of interest does not make any difference in the applicability of 2 subsection 22e. If the loan is being repaid, then farak nahi padta. The when in which the loan has been sanctioned, in that year it is being taxed in the hands of shareholders. Accumulated profit means profit as per Companies Act, not as per taxable profit. Means it is accounting profit. Simple. Section 222 subsection E is not applicable in case of trade advances. Example: advances in the nature of commercial transaction. It is a disability circular. Okay, it is only applicable for other loans and advances not related to trade business. Then following are not treated as dividend: any advances or loans in the ordinary course of business, because it is trading, like of money, lending money for money business is a substantial part of business, like banks. Buyback of shares also not treated as dividend. Any dividend paid by a company which is set off by a company against the loan which has been deemed as dividend under section 222e, then shares allotted to the shareholders of a demerged company by a resulting company under the scheme of demerger, it is necessary, no, that any distribution made under section 222c or d in respect of preference shares are also not treated as deemed dividend. Then section 57, we'll see the following deductions are allowed under section 50 IFOS. In the case of business of dividend or income on units of mutual fund or UTI, only interest expenses are allowed as a deduction, subject to the maximum of 20% of such dividend or income. For example, your dividend income is 1 lakh, up to 20,000 you can claim a deduction with respect to your interest expenses. Okay. Next, in case of rental income from machinery or furniture, amount paid on current repairs and insurance, normal depreciation, allowances on such plant and machinery and furniture can be claimed as a deductions. In case of income under family pension, deduction shall be 1/3 of the family pension or 15,000 per annum, whichever is lower can be taken as deductions. Certain other exemption in respect of family pension: family pension received by a widow or a children or nominated heirs of a member of armed force, including paramilitary force of a union, where the death of such a member has occurred in his official duty, then that is fully exempt under section 10 subsection 19. In order to provide respect, in order to give a respect to them, this exemption has been brought into effect. Then family pension received by any member of the family of an individual who had been in the services of central government and state government, had been awarded Param Veer Chakra or Veer Chakra or Mahavir Chakra or any other notified gallantry award, would be exempt under section 10 subsection 18 subclause 2. The same concept. In case of interest on compensation, both exemptions are over. Now the deductions part. In case of interest on compensation of compulsory acquisition that we have already discussed, equals to 50% of that income shall be allowed as a deduction under this section. No further deduction shall be given in respect of this. Let's example, the court fees, etc. should be ignored. Then any other expenses not being in the nature of capital expenditure laid out or expended wholly or exclusively for the purpose of making and earning such income shall be treated as an allowable expenditure. Then such other exemptions, section 10, section 15, interest on post office saving bank account. If you are holding any post office saving bank account, then it is exempt to the limitation of 3,000 per 500 per account, per single account, or 7,000 in case of joint account. Let's say for example, I am having a joint account in post office with my mother. Then if I am receiving 10,000 as an interest from that post office bank account, then up to 7,000 it is exempt. More than 3,000, more than 7,000 it is fully taxable. Then section 10 subsection 17 says members of the parliament or any state legislature following incomes are exempt. Daily allowances and constituency allowances of MPs or MLAs. But if they opt for 115 BAC, these are to be foregone. Remember, this we have already discussed in the first chapter. Then section 10 subsection 14 subclause 2 says interest on monies lending to the credit of individual in the hands of NRE, that is non-resident emission, actually non-resident, actually NRE account, simple. Then section 10 subsection 10 BC, it says compensation received on account of disaster, tsunami or etc. If you receive any compensation from the government or any other authority, then it is fully exempt. Then section 10 subsection 16, it says educational scholarships are also exempt. Then section 10 subsection 17a, awards for literary, scientific and artistic works and other awards by the government of India is also tax free, it is also exempt. Then section 10 subsection 10a says payment in commutation of pension received from setup by the LIC, it is also fully exempt. Section 58, this is the last concept, expenses not allowed as a deduction. The below are not allowed as a deduction. Section 57 says it is allowable deductions. 58 says non-allowable deductions. Any personal expenditures, it is obviously not deductible. Any interest chargeable which is payable outside India on which the TDS is not being complied. If the TDS is being complied, then it is okay, it can be allowed as a deduction. TDS is not claimed, complied, then is fully ignored, fully disallowed. Then any payment which is chargeable under salary, if it is paid outside India without the TDS compliance, then that is also same concept, is not allowable. Then cash expenditure in excess of 10,000, then the same provision is that we have discussed in PGBP chapter, that the disallowances under section 40A3 is also applicable, and hence the same concept is also applicable here also. There's 30% of the sum payable to a resident on which TDS has not been paid. The same concept we have discussed in section 40A of the PGBP chapter shall also applicable here. In addition, the income from other sources also 30% shall be disallowed. Any expenditure incurred in connection with casual income. Casual income means the horse race, puzzles. In respect of that, any expenditure you incur, it is fully to be disallowed. But there is one concept. However, this provision shall not be applicable. That means for one casual income, you can claim expenditure, for which shall not be applicable for the SSE who is the owner of that horse race from the activity of owning and maintaining that horse race, and any such expenditures are allowed, and also loss can be carried forward under section 74. If you are a owner of that horse race and running a business of the same business, for you that is allowable. For others, simply casual income, treated as casual income, for them it is not allowed. Till here we have successfully completed the last heads of income, that is income from other sources. If you have any doubt, please don't hesitate to mention in your comments box. And the next section will take the deduction under chapter 6 deductions, because if we complete deduction chapter and the last very important chapter is TDS and TCS concept, then almost A and B category chapters are over. The remaining small chapters will be left, that is the set off and carry forward provision and clubbing provision that we'll discuss in the last session of this entire the revision exam oriented lectures. In the next video we'll be coming with the deductions chapter. Till then, stay revise the concept that we have discussed till now, and have a nice day. See you in the next revision.